Good afternoon, everyone. My name is John Grummett, and I'm a partner at Taylor Legal, a tax partner at Taylor Legal. And today we're going to do a little bit of a brief summary of some tax issues related to the taxation of trusts. I'm not going to get into tons of detail on it, but just a bit of an overview and some of the things you should be aware of. So before we start into it, we really should know what the parties of a trust are. So the trust really has three parties with respect to it. There's the settlor, which is the person that conveys a property, whether it be a gold coin or a $10 bill or $20 bill. But that settlor is the person that settles the trust and sets it up. And typically that person has no responsibility after that. Then there's the trustees, and the trustees are the people that hold the assets and administer the trust assets, make all decisions on behalf of the trust. If there's any voting required on shares, they would do all the voting, all that type of thing. And then the third party is the beneficiaries. And the beneficiaries are the people that benefit from the trust. And you can have income and capital beneficiaries. They don't have to be the same, and they don't have to be different either. So that's just three of the parties that I'll make reference to as we go through this afternoon. The next is the type of trust. And again, I'm not going to go through every single type of trust, but really there's two basic types. There's a testamentary trust, which is created on the death of someone. And then there's an inter vivos trust, which is created during someone's lifetime. And so, as I said, there's the testamentary trust. Usually it's created in the will of somebody saying that, on my death, I'm going to leave these assets in trust to my grandchildren. And there's a number of specific rules related to a testamentary trust. And then there's more than one different type of testamentary trust, but a couple of the different types is you can have a testamentary trust, one that's created on death, that is a spousal trust. And in order for it to be a spousal trust, there's a whole host of rules, and I'm going to talk about a couple of those this afternoon, but there's a list of rules that you have to meet in order for it to be considered a spousal trust. And one of the benefits of the spousal trust, if set up properly, when somebody dies and they leave assets in a spousal trust, there's no deemed disposition on death. Those assets go into the spousal trust, no different than if you died and left them directly to your spouse. But as a result of that benefit, you really need to make sure you fall into what's a spousal trust. And then the other testamentary trust that we often see is what's called a graduated rate estate. And the graduated rate estate is really the testamentary trust formed, or the estate formed on death. And a trust can be different than an estate, but in this case, the estate is formed on the death of an individual, and it becomes a testamentary trust. And the big difference with the graduated rate estate, just by the name of it, is it has the graduated tax rates. And those graduated tax rates, though, only apply for the first 36 months of the trust. And then the other type of trust is inter vivos, and it's created during the settlor's lifetime. Whereas in the testamentary trust, the settlor is really the person that passed away and left the assets to the trust. This is somebody creating the trust while they're alive. And similarly, there's a number of different types of testamentary trusts. There's a qualified disability trust, which is set up for a disabled individual. There's an alter ego trust, and the alter ego trust is set up by an individual. Basically, in this case, the settlor and the beneficiary are the same person. And there's a number of specific rules related to this trust, but the main one is it can't be set up until the taxpayer or the settlor is over age 65. And then essentially what happens is the settlor is the beneficiary, puts assets in the trust. It's a way of avoiding probate. It's a way of keeping items out of your estate. And in this case, with an alter ego trust, there's no 21-year rule, which I'll talk about the 21-year rule in a little bit. But with the alter ego trust, when the person that set it up dies, there's a deemed disposition at that point. Whereas with other types of trusts, there usually isn't a deemed disposition until the 21st anniversary. And then the other common inter vivos trust is one that's called a joint spousal or common law partner trust. And this is very similar to the alter ego trust, only this one is set up where there's two partners, either two spouses or common law partners that create the trust and contribute to the trust. And again, it's set up while alive. And again, the settlers of the trust are the two partners or spouses, and the beneficiaries are also the two partners or spouses. So it's usual that we don't want the settler to be a beneficiary, but in the alter ego trust or the joint spousal common law partner trust, the settler has to be the beneficiary. Okay, so it has very specific purposes in this type of trust. Okay. And as I said, the purpose of these two types of trusts is really probate savings, confidentiality, in that when somebody passes away, their will can be shared by the public, whereas with a joint spousal trust or joint partner trust and an alter ego trust, there's no sharing with the public of the assets or the information, sorry. And then it allows you to control the capital a little more as well. Okay. So what I want to chat about now is just some specific rules related to trusts and some issues you may run into as well. So the first one is with a trust other than an alter ego trust and a joint partners trust, there's a deemed disposition every 21 years. So that means all of the assets inside the trust are considered to have been sold and then bought back at fair market value. So any accrued gains or losses inside the trust are triggered. And really the only way of avoiding this is to distribute the assets out of the trust before the 21st anniversary. So for example, if you, let's say you had a trust with shares of a private corporation and you're coming up on the 21st anniversary, you could distribute those shares out to the beneficiary, and then the trust would no longer have those shares on the 21st anniversary, and there wouldn't be a deemed disposition of them. Sometimes what we'll do is we'll freeze those common shares into preferred shares, distribute the preferred shares out because that's where the gain is, and then leave the new common shares, which really have no value in the trust, for the next 21st anniversary. And this is every 21 years this applies. It's not just once. If you have a trust for 42 years, it's going to apply twice. The other provision here you need to be very careful of is subsection 75(2). And when I said that usually you don't want the settler and the beneficiary to be the same on a trust, that rule applies in every case except for the alter ego trust and the joint spousal trust. Because if the settler is also a beneficiary, subsection 75(2) will apply. And what 75(2) does is it says that where, and I'm paraphrasing here, but it says where the settler has the ability to control what happens to the assets or has the ability to get the assets back, then all of the income related to those assets attributes back to the settler. And the other thing it does is if 75(2) applies, then you cannot roll the assets out of the trust at cost, for example, immediately before the 21-year rule. So if you're planning on distributing those assets out in the 20th year of the trust and you didn't set it up properly, so 75(2) is going to apply, well, then you can't transfer those assets out of the trust at cost. They have to come out at fair market value. So the main things you want to make sure of, there's a whole host of rules, but I'm just going over it briefly here today, is the main issue is the settler cannot control what's going on in the trust after it's been set up, and the settler cannot get the assets back or have the ability to direct who gets the assets. So if the settler is a beneficiary, obviously he or she could get the assets back, and that's not good. And also the settler, I typically don't like the settler to be a trustee as well, but I have seen trusts where the settlor is a trustee. But if that's the case, the settlor cannot have the controlling vote, and there has to be at least 3 trustees then. Because if the settlor can control the vote, then he or she would still have control over the assets and could determine who was going to get those assets. So my feeling is when you're setting up a trust, the settlor sets it up and then has no more responsibility ever again with that trust. Okay. The next issue is with the income of the trust. The income can be taxed in the trust, or it can be allocated out of the trust to the beneficiaries. And with most trusts, most of them now are subject to the high personal tax rate, other than the graduated rate estate trusts. So if a trust is going to be subject to the high personal tax rate, often you want to get that income out of the trust and taxed in the hands of the beneficiaries. Well, in order for that to happen, the income has to be either paid or payable at the end of the year, which would be December 31st. So paid is pretty easy to determine. You look and you see that, yes, here's how much was paid to the beneficiaries, so that's how much I can allocate out to them. But the term payable has a lot of interpretation. And so if you create a note payable by the trust to the beneficiary, number one, it has to be enforceable. And number two, it has to be dated prior to the end of the trust taxation year. You can't say it was payable on December 31st if the note was dated February 15th of the next year. Okay, so I often like to pay because it has less issues around arguing with Revenue Canada as to whether it was paid or not, because payable does have that degree of uncertainty. Okay, next we're going to just talk about a few trust issues. So the first we run into is an association issue. So in this example, if dad owns Dadco and there's a trust set up whereby his children are beneficiaries of the trust and the children are minor beneficiaries, well then, and that trust owns the shares of OpCo, well, under Section 256 1.2 of the Act, it deems the beneficiary of a discretionary trust own 100% of the shares. And the other thing it does is if those are minor beneficiaries, it deems mom and dad to own the shares of the minor beneficiaries. So in this example, where you set up the trust where dad owns all of the shares of Dadco, and I've even seen it where mom and dad aren't beneficiaries of the trust, just the children are, but the children are minor beneficiaries. Well, then mom and dad are deemed to own all of those shares of OpCo, and as a result, these two corporations would be associated. So you have to be careful of that because you could run into an instance whereby you didn't think they were associated. So this is going to affect, the small business deduction, R&D expenditure limits, the aggregate investment income rules, on all that kind of stuff. Okay, so that's one thing to be careful of. Second one to be careful of is TOSI and tax on split income. And under the definition of excluded shares in TOSI, which if shares are excluded shares, then the TOSI rules don't apply. But one of the conditions to be excluded shares is it says that you personally own the shares in aggregate, giving you at least 10% of the votes and value of the corporation. Well, if the children are beneficiaries of the trust, and maybe the trust owns 100% of the shares, the children don't personally own those shares. So as a result, the children wouldn't get out of the TOSI rules under excluded shares if the shares are held in a family trust. So that's where you may need to distribute some of those shares out of the trust directly to the children so they meet that 10% test. Third issue to be careful of here is with an alter ego trust. If the alter ego trust, remember, it's a trust that an individual sets up in their lifetime, and on death of the alter ego trust, there's a deemed disposition of the assets of the person that set it up. Okay, So there's a couple issues with this. Number one is it with the alter ego trust, there is a deemed disposition at the time the settlor or the beneficiary, which is the same person, at the time they die. Okay. And then the other issue you have with an alter ego trust is there's no rollover to a spouse at cost. Okay. There's a deemed disposition at death, but no rollover. If you were wanting to have a rollover to a spouse at death, then you should have set up a joint partners trust or a joint spousal trust. The alter ego trust won't allow you to have that deferral or passing on to the spouse at cost. Okay. The next issue is around the principal residence exemption. And these are the old rules up to 2017 where a trust could claim a principal residence exemption. And all that had to happen is it had to be a housing unit, obviously, that was owned by the trust. And one of the beneficiaries had to ordinarily inhabit the housing unit. And then the trustees could designate it as principal residence. And there had to be no corporation as beneficiary and a few other issues there as well. But in 2017, what they did is they changed the rules around trusts owning principal residences. So now, after 2017, if a trust has a principal residence, it either has to be an alter ego trust, a joint spousal trust, a qualified disability trust, or a trust that was set up by deceased parents for minor beneficiaries. So if you don't have one of these types of trusts and you've got a principal residence inside the trust, it won't qualify for the principal residence exemption anymore. So there was some transitional rules in 2017 when this happened, but I would suggest we've got an example where a lady set up a trust for her niece and put the principal residence in the trust for her niece, and now the niece the aunt has passed away. The niece has the house in the trust, but it's no longer going to qualify for the principal residence exemption after 2017. What else do we have here? This is one I just spoke about where if you're going to transfer property to beneficiaries to avoid the 21st anniversary, you have to make sure that 75(2) has never applied to the trust. And if you're going to transfer assets to a beneficiary at cost, it can't be done to a non-resident beneficiary either. The next one then is Section 74.4. It's an attribution rule. And basically when you're transferring property to a trust or transferring property to a corporation by way of a trust, you could run into attribution rules. And these attribution rules usually apply between spouses or minor children. So if you're doing an estate freeze and you're bringing in a trust, you need to be very careful of the 74.4 rules. They don't apply as long as the corporation's a small business corporation, but oftentimes it might be a small business corporation when you set it up, but then later on it is not, and they fall offside, and therefore 74.4 starts to apply. So be very careful of that. Last one here. Let me just see how many more I got. I think this will be the last one. This is where we have a trust that is a corporate beneficiary of the trust. The trust has a corporate beneficiary. So that means the trust may have 3 or 4 individuals, maybe all the family members, but then they also say one of the other beneficiaries of the trust is a corporation. And what this allows, if the trust owns shares of an operating corporation, the operating corporation can pay a dividend up to the trust, and then the trust can allocate it out to the corporate beneficiary, and there's no tax on it, assuming there's no refundable tax inside the operating company. But the issue you run into is if let's say you've got 2 unrelated families, they each own 50% of the shares of a corporation, and they each decide to set up family trust to own their share interest, and each of them decide they're going to have corporate beneficiaries of their trust. Well, if the corporate beneficiaries are not controlled by the same people that control the operating company, then the corporations are not going to be connected, and you're going to have Part 4 tax inside the corporate beneficiary as you pay a dividend up. If it's a situation where the same family owns 100% of the shares of OpCo, or owns more than 50% of the shares of OpCo, and they control the corporate beneficiary, then you won't have that. But if you had, let's say, 3 families, they each had a third of the shares of OpCo, and they each had family trusts, well, those families are not going to be able to control OpCo, and therefore OpCo and the corporate beneficiaries are not connected. And as a result, when you pay a dividend from OpCo up through the trust and out to the corporate beneficiary, it's going to be subject to the Part 4 tax rules. Okay, last thing I just wanted to give a small note on is there are new trust reporting rules coming out. They were supposed to be out for December 31st, 2021. We're right into trust season right now, and those enhanced reporting rules got deferred until December 31st, 2022. So we'll probably do another session at some point talking about what those deferral rules are. I did a session last fall talking about them, but there'll be more coming up on that as we go through the next tax season. But for now, those rules are deferred until December 31st of 2022. Okay, so that's it for a summary on trust rules. Hopefully you got something out of that, and it's not an in-depth discussion, but it gives you some things to be careful of when you're working with trusts. So thanks very much and have a great day.